I'm just going to give people another 30 seconds to log in, and then we will get started. Good morning and welcome to the ParkBridge Wealth Management Fall Webinar Series. This program is entitled International Estate Planning Traps for the Unwary. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my program is to bring professionals together to help them better serve their clients, and this is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles, or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that in Apple, Spotify, or wherever you get your podcast. Today, we're privileged to hear from K. Eli Akhavan, who's a partner at Grant Herrmann, Schwartz, and Klinger based in New York. Eli focuses his practice on tax and estate planning for high net worth U.S. and non-U.S. clients. He advises domestic and international individuals and families with respect to tax and estate planning for their U.S. assets and beneficiaries, and incorporates dynasty trust planning for his clients. Eli also advises cross-border clients in all aspects of international estate matters, including foreign trusts, pre-immigration expatriation planning, and on structuring investments in U.S. real estate and U.S. financial assets. Eli has considerable knowledge on the reporting requirements applicable with respect to foreign financial accounts and assets, and with respect to FATCA and its global equivalent, the Common Reporting Standards, as well as the Corporate Transparency Act. In addition to his professional responsibilities, Eli is a thought leader in the field of estate planning. He serves as an adjunct professor of law at St. John's University Law School, teaching international taxation, as recognized authority on tax and estate matters, having been quoted in the Wall Street Journal, Fox Business, and Bloomberg News. Today, Eli will be speaking about international estate planning, traps for the unwary. And with that introduction, I'll now turn the program over to Eli.
Thank you, Jonathan, and good morning, and to all the attendees. Thank you, Jonathan, for arranging these sessions and programs for the general benefit of the public. It's always good to keep up to date on estate and tax matters as they're developing, especially these days where there's definitely proposals out there from the two different potential administrations. So thank you for that. And also, I appreciate everybody joining us this morning. It is somewhat of a challenge to cover all of international estate planning within 30 minutes. But our goal is to really cover what advisors should know, attorneys, CPAs, wealth advisors, and others who deal with clients in the wealth management business and in the wealth advisory. As Jonathan mentioned, I'm an attorney practicing in the field of tax and estate planning for cross-border and domestic clients, and about half of my practice is devoted to cross-border matters. And when I say cross-border, that could mean either U.S. individuals that have foreign assets, foreign beneficiaries, and foreign interests, or more commonly, it refers to the helping clients who are from abroad that either have U.S. assets, have U.S. beneficiaries, or other U.S. investments that they like to plan for and need tax advice and certainly tax planning. The interesting part about international estate planning is that it's not always intuitive. There are rules that may not seem to make sense. There are rules that seem to just not be consistent with other general tax rules. And all of those elements lend themselves to having traps for the unwary. So what we're going to do today is discuss a little bit of the basic law, that applies to both US and non-US individuals in the estate planning world. And then I'm going to present 10, I would say, more frequently presented items that come across my desk on a day-to-day basis in dealing with international estate planning. And as you'll see, international estate planning doesn't just mean having a US client with foreign assets or a foreign client with US assets. If you have clients where one of the spouses is a green card holder but not a citizen, you're going to have a potential foreign issue there that needs to get addressed. And it's becoming more and more common for advisors to deal with international estate planning issues. We are, to quote the cliche, becoming more globalized, and the world is becoming smaller. So international planning is becoming more and more prevalent across the board for wealth advisors. Now, with that, let's dive right in. To really understand international estate planning, it's important to obviously have an understanding of the estate and gift tax rules, but just as important, it's necessary to have an understanding of how the income tax rules apply to non-US persons. And we're going to dive into that. So let's go with the baseline, how the US income tax applies to US persons. So US persons are subject to US federal income taxation on their worldwide income, top rate of 37%. There could be a 20% deduction that applies. Long-term capital gains are taxed at the top preferential rate of 20%. There's a 3.8 net investment income tax, also known as the Medicare tax on passive investments, if a US taxpayer reaches certain thresholds. That's the general rule. Most of us are familiar with that. Let's go to how non-US persons are taxed for US federal income tax purposes. Well, there are generally two big buckets for how non-US persons are taxed. First is what's called FDAP income, and second is what's called ECI income. FDAP income refers to fixed, determinable, annual, and periodic income. That includes dividends, interest, rent, royalties, commonly to be periodic, and then determinable income. The way FDAP income is taxed is that it's subject to 30% withholding at the source, unless there is a special treaty exemption that lowers that withholding rate, and it could lower it to 20%, 15%, 5, 0. It's all across the board. The next bucket is the ECI income. ECI income earned by a non-US person is income that is effectively connected with the US trade or business. There's no strict definition or literal definition of it under the code, but generally you can think of it as an operating business here in the United States. That income is going to go to a non-US person. That's ECI income. The way ECI income is taxed is generally the same way as a US person is taxed. There's going to be income minus deductions and expenses, and the graduated rates that we discussed, as I said before, the top rate of 37%. Now, a lot of people would say, oh, that's great. If the top rate is 37% for ECI income and gross and the rate for FDAP income is 30%, I would generally want a FDAP categorization. That's false. It's a false idea to apply here, because FDAP income is taxed at 30% withholding on gross income. No deductions are allowed. Whereas when it comes to ECI income, expenses and deductions are allowed against the gross income, and that's what's taxed. So the effective tax rate, even though the real tax rate is 37%, or the nominal tax rate is 37%, the effective tax rate could be much lower and could come even below the 30% gross withholding. So that's something important to note. Now, what we're going to see within international estate planning, and we see it in the regular tax world, but we see it definitely a lot within the international tax arena. There are rules, there are exceptions to the rules, and there are exceptions to the exceptions to the rules. So that, again, presents traps for the unwary, which, again, we're going to discuss a bit further in. Now, the exceptions for certain types of income is, for example, portfolio interest. So if an individual, so generally there's a 30% gross withholding on interest payments made to a non-US person. But if that interest is structured as a loan that would be categorized as portfolio interest, no taxation. We use this a lot within the field of international tax planning to exempt interest payments going to a foreigner from US taxation. Capital gains, this is a big one. A non-US, non-citizen, non-resident of the US who has capital gains that you would think are sourced in the United States. So say they purchase Tesla stock, goes up, and they sell it, there is no taxes there. There's no FDAP income, there's no ECI income. A non-US, non-citizen, non-resident is not taxed on capital gains. They own shares in another corporation, a privately held corporation. They sell it, no taxation. Now, remember when I said there's going to be exceptions to the exceptions? Well, within capital gains, you have that. So if it's disposition of interest in U.S. real property, capital gains tax does apply. If it's dispositions of partnership interests, under certain circumstances, there's going to be capital gains tax applied as well. So you have to be a little bit careful in how these rules apply. But again, this is just a general overview. There's no net investment income tax for non-US persons, so they save the 3.8%. Just, I guess, as a preview, this comes up if we're structuring foreign trusts for non-US residents and citizens. They can avoid the 3.8% Medicare tax within that trust as well. Now, I keep referring to this US person and a non-US person. Well, what do those words mean? And the one thing that I want everybody to take away, if nothing else, is that just because an individual is a US person for income tax purposes does not mean that they are a US person for estate and gift tax purposes. So an individual could be a normal US paying tax payer. Today is October 15th. They're filing 1040s regular way. They may not necessarily be a resident or a US person for US estate tax purposes. So that's something to keep in mind. So let's go through those, and then we're gonna dive into some of the traps for the unwary. So for US income tax purposes, a person is an individual is a US person if they are either a citizen of the United States or a resident of the United States. So if you're a citizen or a resident, you are a US person for US income tax purposes, subject to worldwide taxation on subject to US taxation on worldwide income. So citizen, we know what that means. You become a citizen of the United States. Simple enough. What does it mean to be a resident for income tax purposes? Well, two main tests. If you're a green card holder, you are a resident for income tax purposes. I get this question a lot. My spouse just got the green card. Do I still have to pay? Do I have to pay U.S. taxes? The answer is yes. Green card holder is a U.S. resident for income tax purposes, subject to U.S. taxation worldwide income. The next test, or alternative test to becoming a U.S. resident, is to meet the substantial presence test, and that simply means being in the United States for 183 days based on a certain type of average. One, you're in the U.S. for all the days of, you're here for 183 days based on a formula. So the formula is based on, you look at all the days of the current year, that adds up to 183, U.S. resident. If the current year does not add up to 183, you look at the prior year and the current year, and you look at the prior year and you count 1/3 of those days. So take, for example, the year 2024. 2024, you're here for 183 days, U.S. resident. If not, you look at last year's 2023, take 1/3 of those days, and if that still doesn't add up to 183, you add 1/6 of 2 years prior to 2022. So if you take 2024, 2023, and 2022, based on that formula, and you have 183 days, you got a U.S. resident for income tax purposes. Now, back to exceptions. Exceptions are allowed for stays in the United States due to certain types of medical stays, not all. Certain visas, if individuals are here on certain types of visas, immigration visas in the United States, those days won't count. And then there are treaty tiebreakers. So an individual could be present in the United States for a certain number of days, but based on the treaty that exists between the United States and another country, for one I'm working on recently, Mexico. Under U.S.-Mexico treaty, an individual has more of their home base and more of their center of economic vital interest is in Mexico. Then, based on that treaty, and a period position has to be taken, that individual, even though they meet the residency test or substantial presence test in the United States, they are considered still a resident of Mexico and won't be subject to U.S. taxation. Now, for federal and state gift tax purposes, we know the general rules for U.S. citizens and domiciliaries. They're subject to estate and gift tax on their worldwide assets, rates up to 40%, currently a $13.6 million exemption. Key point here, and we're going to dive into this a little bit, gifts between spouses qualify for unlimited marital exemption, unless the gift is from a U.S. person to a non-citizen spouse. So a green card holder spouse, and you have a U.S., let's say, husband, green card holder wife, gifts from U.S. husband to green card holder wife, even though she's been living in the United States, does not qualify for the unlimited marital deduction. There's some relief there, but not complete, but we're going to get into that. Those are the general rules for U.S. persons. Non-U.S. persons gets a lot more interesting. So non-citizens, non-residents are subject to U.S. estate tax under U.S. situs assets. So if they are deemed to own U.S. situs assets, they are taxed on those assets. They are given a very generous $60,000 exemption. This amount is not indexed for inflation. It's always been the same. So while we all enjoy a $13.6 million exemption, they only have a $60,000 exemption. Now, there are treaty rules that come into play based on the country of the individual's residence that may modify that amount, but that's the default rule. Non-citizens, non-residents are also subject to gift tax of gifts of U.S. situs assets. Now, this is very key. Just because an asset is a U.S. situs asset for U.S. estate tax purposes does not mean it is a U.S. situs asset for gift tax purposes. Why? We don't know. There are just inconsistencies in the rule. I mean, the way the rules work is that they provide that certain assets are U.S. and some are not U.S., but does not necessarily mean that the two are in line and conform to each other. There's no lifetime transfer exemption, so there's no $60,000 exemption for gifts. There is no $13.6 million, but foreign individuals can benefit from the $18,000 annual exclusion. As I mentioned before, gifts of U.S. situs assets to gifts of U.S. assets to a non-citizen spouse don't qualify for the marital deduction, but there is a separate annual exclusion of gifts to a non-citizen spouse of $185,000. That's indexed for inflation, and that amount is for 2024. Now let's get a little bit into the more interesting part. So, as I mentioned, what's deemed to be a U.S. situs asset for estate tax purposes is not necessarily mean it's going to be deemed a U.S. situs asset for gift tax purposes. So what's a U.S. situs asset for estate tax? Well, real estate located in the United States, tangible personal property located in the United States, shares of stock in the U.S. corporations. So if an individual owns stock in, again, Tesla, so we know they're not subject to capital gains if they dispose of it at a appreciated Tesla stock. But if an individual, a non-citizen, non-resident, dies with shares of stock in the U.S. corporation, that's going to be deemed to be part of their estate. Cash deposits in brokerage accounts. So somebody owns, non-citizen, non-resident owns cash with Charles Schwab or Ameritrade, anything of that nature, brokerage house, that's part of their estate U.S. situs assets for estate tax purposes, but not bank deposits, because for whatever reason we've decided we're going to encourage bank deposits, but not deposits with brokerage accounts. Life insurance paid by a U.S. insurer on the life of a non-U.S. person is not U.S. situs property. Essentially, if you have a life insurance company paying a non-citizen, non-resident life insurance, that's not considered part of their U.S. situs asset. Even though for a regular U.S. individual who lives in the United States, is domiciled in the United States, that's, unless you put it into an irrevocable life insurance trust, life insurance proceeds are part of an individual's estate. That same rule does not apply for a non-citizen, non-resident. Gift tax. What is a U.S. situs asset? Well, again, similar to estate tax, real estate located in the U.S., tangible personal property, does not include shares of stock in U.S. corporations. That's one big difference. So if a non-citizen, non-resident owns stock in the United States and they want to gift it, no problem, not subject to the gift tax. If they die with that, it is subject to the estate tax. So these are just some key points to know once we get to traps for the unwary. Now, I mentioned at the outset that it's important to know that just because you're a U.S. person for income tax purposes does not mean you're a U.S. person or resident for estate and gift tax purposes. So what does it mean to be a U.S. resident and to be subject to estate and U.S. estate and gift taxation? Well, the individual has to be domiciled in the United States. To be domiciled in the United States means you are present in the United States and you have no definite present intent to leave based on the facts and circumstances. So it's not based on the day count. It's not based on citizenship. It's not based on holding a green card. It's being in the United States and not having any intent to leave. Now, that's going to be based on the surrounding facts and circumstances, and the regs set them out. Essentially means you've moved to the United States, your job is here, your family, your wife and children are here, you brought all your artwork from a different country, and you're here for a day, you are subject to U.S. estate and gift taxation. Having a green card, as I mentioned, does not make you per se a U.S. estate and gift tax resident, but it's certainly a strong factor in favor of residency for estate tax purposes. Now, keep in mind what that means. It just means that an individual, this non-citizen, we'll say, came to the United States, now they're subject to worldwide taxation. They're subject to U.S. estate and gift taxation under worldwide assets. Well, if they're just treated like any other U.S. person, all that means is that they have a $13.6 million exemption. And with that $13.6 million exemption, if they're below that amount, they may not even care. And in fact, they may be able to make gifts without any worries. They may be able to have U.S. situs assets above the $60,000 because they're considered a U.S. resident, and they'll have a $13.6 million exemption. So for clients that have assets below that amount, you may prefer that sort of classification as a U.S. person resident for estate and gift tax purposes. So it's important to note that just because you're subject to U.S. worldwide to U.S. taxation, estate and gift taxation on worldwide assets, it may not be the worst thing, unless, of course, your assets are above that amount and you only want to be subject to U.S. situs to taxation U.S. situs assets. So it's really a case-by-case scenario. But again, the main takeaway is that these two are not the same. So let's go to, and I've included a lot more material in the slides on planning and on different situs rules for different types of assets, such as partnerships, LLC interests, for example. We don't have much time to go into it because I want to really dive into the traps for the unwary, just to have takeaways. But you're gonna have my contact information. Please feel free to contact me with any further questions. So with the 6 minutes remaining, I'd like to go through some of the traps. We've already covered one: status as a U.S. income taxpayer does not mean status as a U.S. gift and estate and gift tax resident. So in advising and planning your clients, always make sure you have two separate analyses. Is my client a a resident for income tax purposes. That's easy enough to determine. It's either you're a citizen, a green card holder, or have been in the United States under the substantial presence test. Estate and gift tax residency is a little bit more, I don't want to say difficult, but it's not as much of a bright line test to determine. It's based on the facts and circumstances. 2, a non-citizen spouse, this bears repeating, even if they are a green card holder, has lived in the United States for decades and decades, and is a U.S. income tax resident, does not qualify for the same benefits as a U.S. citizen spouse when it comes to the unlimited marital deduction. And I've seen these cases a lot. I've had clients that literally they've lived in the United States since World War II, and they came from a different country. For whatever reason, they never got their citizenship. They do not qualify for the unlimited marital deduction. Now, why is this important? Because you go to number 3, creation or forming a joint bank account with a non-citizen spouse, or owning jointly held real estate with a non-citizen spouse may be deemed as the creation of having a taxable gift. So this comes up frequently if you have one U.S. spouse or 2 non-citizen spouses. You have one U.S. spouse and a non-citizen spouse, or you have 2 non-citizen spouses, and they form a jointly held bank in the United States, or they take title to real property as tenants by the entirety or joint ownership. You may have a gift being made from the moneyed spouse to the non-moneyed spouse who's a non-citizen spouse. It's something to watch out for. It's, usually these cases come to me after they've been formed, after many years, and potentially there's a taxable gift there. Now, when it comes to a U.S. spouse who creates a joint tenancy with a non-citizen spouse, all that means is you've used up their exemption amount to $13.6 million. But when you have the creation of joint accounts between 2 non-citizen spouses, it gets a bit more complicated. So from the outset, if at any time your client, one of them is a non-citizen spouse, just be aware of this and see if you can plan around it from before. The next trap, understanding the rules for U.S. situs assets versus non-U.S. situs assets. The creation of a non-U.S. situs asset is, of a U.S. situs asset is sometimes easy enough to do. Having a brokerage account, owning real estate, owning shares in a U.S. corporation. All these lead to having a U.S. situs asset. Now, with most assets, there are structures to get them from being a U.S. situs asset. You can have them owned initially by an irrevocable trust. You can have them initially owned by a foreign corporation, because foreign corporation that owns U.S. situs assets, that itself is not considered a U.S. situs asset. That's the way we typically structure around the estate tax. But just be aware of these rules, and before your non-citizen, non-resident client is making a purchase of assets in the United States, consult with somebody to structure it properly so you don't have this problem later on. And again, like I said, shares of a U.S. corporation are subject to estate taxation, but not gift taxation. So be aware of the rules where they may be inconsistent between the 2 regimes, but same type of asset. Number 6, this comes up a lot. Gifts, they asked me, Eli, my son's in the United States, and I have an account in the United States. Can I just wire him some money from one U.S. bank account to another U.S. bank account? We really never recommend that. Never to have cash flow from one U.S. bank account to another U.S. bank account, because that could cause a taxable gift. It's as if there's a gift of a U.S. situs asset. What we really like to do and to plan around is to have a foreign bank account set up for the non-citizen, for the U.S. individual, and have any transfers happen abroad. The next best way to do it is to have to convert cash into treasury bonds or U.S. stock and transfer the stock, because that's definitely not considered transfers of a U.S. situs asset for gift tax purposes. QDOTs. So one, as I mentioned, Non-citizen, non-resident spouses, actually non-citizen spouses don't qualify for the unlimited marital deduction. The way around that is to bequeath assets to them to what's called a qualified domestic trust. That's a QDOT. I have materials on the slides on what a QDOT is and how they work. You can review those, but that only works for testamentary bequests and not for lifetime gifting. As time is winding down here, I'm going to run through these. Failure to consult with the appropriate estate or gift tax treaty. Very important to always consult to see if there's a estate or gift tax treaty in effect between your country's home jurisdiction and the US, because that could provide a lot of relief. Income tax considerations. Make sure you don't, failure to consider income tax considerations could really cause a heavy tax hit, and that comes up with respect to real estate and FERPTA. Know that capital gains isn't subject to income taxation for non-citizen, non-resident, unless certain exceptions apply. If you have a client and they're a foreigner and you appoint them as a trustee of a U.S. trust, you have converted that U.S. trust into a foreign trust with a parade of parables that can happen. So be careful with that. And finally, failure to consult with the client's home jurisdiction attorney. Always consult with whatever domicile your client is from, the foreign client. Make sure whatever planning you're doing for them is consistent with their home country. For example, in Australia or in Greece, if you were to transfer assets to a revocable trust, even though for U.S. tax purposes that's ignored, in those countries you may trigger income taxes. You got to be careful with that. For succession rules, there's certain rules that in terms of how assets are supposed to pass on to the next generation. Every country, in U.S. we have generally testamentary freedom. We can dispose of assets how we wish. We can't disinherit a spouse in most states, but in other countries, part of your assets must go to your children. So be careful with that, and always consult with client's home attorney. So I hope I've given you the basics of what you need to know and understand for international tax planning and estate planning. And as I said, feel free to contact me if you have any questions.
Great. Thank you so much, Eli. And if anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, you can feel free to reach out directly to Eli or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. And as I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, my fall webinar series continues on October 31st on the topic of To Trust or Not to Trust, a tutorial on trust planning for wealthy families and their advisors, featuring Krista Fensky of Cole Schatz, based in Hackensack, New Jersey. I'll send that invitation to this program in the coming days. In the meantime, if you have a friend, colleague, or client who would like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line. I'll add them to my webinar distribution list, and my email is jonathan@parkbridgewealth.com. Second, you can follow all my work on X and Instagram at Jonathan on Money. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And third, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.